Before we begin, I want to invite you to subscribe to this channel if you value thoughtful, disciplined financial analysis. We focus on understanding markets through the lens of history, psychology, and fundamental principles, not noise or speculation. A subscription ensures you receive insights designed to strengthen your long-term decision-making. There's a red subscribe button on screen now. Thank you for being here. Good morning. We're living through an era of unprecedented financial complexity. Central banks are managing trillions in assets. Corporations are navigating supply chains that span continents. And institutional investors, particularly the largest banks on earth, are making quiet, strategic moves that most retail investors never hear about. Today, we're examining one of those moves. JPMorgan Chase, the world's largest bank by assets, has taken a significant position in precious metals, specifically silver. On the surface, this might sound like a minor portfolio adjustment. But when you understand the deeper context, the macroeconomic pressures mounting globally, the historical role that precious metals play during periods of currency instability, and the scale of JPMorgan's position, a more complex picture emerges. This isn't a prediction. It's an investigation into what this move might signal about where institutional capital believes risk and opportunity are concentrating. The question we're asking today is simple but profound. What does JPMorgan's positioning in silver tell us about the financial landscape ahead? And more importantly, what should you do about it? We are living in an unusual moment in financial history. Interest rates, which had been near zero for over a decade, have been raised aggressively by central banks. Inflation, which many economists dismissed as transitory, persisted longer than expected. Governments around the world carry debt levels not seen since World War II. When you combine these conditions, elevated debt, uncertain inflation, geopolitical tension, and fragmented global trade, investors and institutions begin thinking differently about portfolio construction. They start asking, which assets hold value when currencies weaken? Which assets are uncorrelated to stock markets and bonds? Which assets have intrinsic value that cannot be printed or diluted by central bank policy? The answer to all three questions points to precious metals. Let's step back for a moment. Precious metals, gold, silver, platinum, have served as a store of value for millennia. This isn't sentiment or superstition. It's because these metals have several unique properties. First, they cannot be created by government decree. You cannot print silver. You cannot issue more of it through quantitative easing. This makes precious metals fundamentally different from fiat currency, which can be created infinitely. Second, precious metals are historically uncorrelated to other financial assets. When stock markets fall, precious metals often rise. When bonds underperform, precious metals provide ballast. This diversification benefit is powerful during periods of financial stress. Third, precious metals are universally recognized as having value. Whether you're in New York, Shanghai, Dubai, or São Paulo, an ounce of silver has intrinsic worth. No counterparty risk, no corporate earnings expectations, just raw physical value. This is why, during periods of currency instability, the 1970s inflation crisis, the 2008 financial collapse, the post-pandemic monetary expansion, precious metals historically outperform other assets. When we talk about precious metals in an institutional context, gold usually dominates the conversation. Gold is the larger, more liquid market. Central banks hold gold as their ultimate reserve asset, but silver is different. Silver is smaller, it's more volatile, and it serves dual purposes. On one hand, silver is precious metal, a store of value. On the other hand, silver is an industrial metal. It's used in electronics, solar panels, medical devices, and manufacturing. This dual nature makes silver fascinating to institutions. Silver holds value as a monetary hedge, but it also has genuine utility demand. This means silver's price is influenced by two separate forces: the macroeconomic factors that drive precious metals generally, and the industrial demand factors that drive commodities. When both forces align, when investors are seeking monetary hedges and industrial demand is recovering, silver can move significantly. A large institution like JPMorgan understands this dynamic intimately. If they're taking a meaningful position in silver, they're not just betting on inflation. They're positioning for a specific constellation of economic conditions. JPMorgan Chase is not a typical investor. As of the most recent data, JPMorgan manages approximately $4 trillion in assets. It operates in virtually every financial market on Earth. It serves governments, central banks, corporations, and ultra-high net worth individuals. And when JPMorgan makes a strategic move in any asset class, it matters. Not because JPMorgan is infallible, no institution is, but because JPMorgan has access to information, analysis, and market intelligence that few organizations possess. JPMorgan's research teams include some of the world's leading economists, geopoliticists, and market analysts. Their trading desks execute billions of dollars in transactions daily. Their treasury management group is responsible for managing the bank's own capital allocation across dozens of asset classes. So when JPMorgan takes a concentrated position in an asset, it reflects an institutional view about where risk and opportunity are concentrating. Over the past year, JPMorgan has significantly increased its precious metals holdings. More specifically, the bank has increased its physical silver inventory and its exposure to silver through derivatives and financial instruments. This isn't a casual move. Financial institutions don't accumulate large precious metals positions on a whim. This reflects a deliberate allocation decision. What might this decision signal? Several possibilities. The first is a genuine concern about currency stability and inflation. If JPMorgan's economists believe that inflation will remain elevated or reaccelerate, particularly if monetary policy is forced to remain accommodative despite fiscal pressures, then silver becomes a logical hedge. The second is a view about industrial demand. If JPMorgan believes that renewable energy deployment will accelerate or that semiconductor demand will recover, then the industrial component of silver's value proposition becomes attractive. The third is a contrarian positioning. If JPMorgan believes that silver is fundamentally undervalued relative to the risks mounting in the financial system, they may be building a position ahead of broader market recognition. The fourth is hedging. JPMorgan itself is exposed to interest rate risk, currency risk, and geopolitical risk. Silver can serve as a hedge against these exposures. In reality, the answer is probably some combination of all four. Let's examine history for context. There are several moments when major institutions significantly increased precious metals positions, and what happened afterward. In the late 1960s, as inflation began rising in the United States and the Bretton Woods system came under strain, major financial institutions quietly increased their gold holdings. This positioning preceded the collapse of Bretton Woods in 1971 and the subsequent bull market in precious metals. In the mid-2000s, as credit spreads tightened and leverage accumulated throughout the financial system, institutional demand for gold accelerated. This positioning preceded the 2008 financial crisis and the subsequent decade-long bull market in gold. In 2010 to 2011, as central banks aggressively printed money following the financial crisis, precious metals surged. Institutions that had built positions ahead of this monetary expansion benefited substantially. None of these precedents guarantee future outcomes, but they do illustrate a pattern. When major institutions move into precious metals, it often signals that they perceive real risks mounting in the financial system. This is the critical question. JPMorgan's increased silver position might be signaling. If inflation remains sticky, or if monetary policy is forced to remain accommodative longer than currently expected, silver would likely appreciate. If financial conditions tighten significantly, if credit spreads widen, if leveraged positions are forced to be unwound, investors typically shift toward less risky assets. Precious metals benefit from this rotation. Periods of geopolitical tension historically drive investors toward assets perceived as truly safe. Gold and silver with no counterparty risk and universal recognition as value fit this description. If the US dollar weakens significantly, or if confidence in major fiat currencies is tested, precious metals typically appreciate. Again, none of these outcomes are certain. But JPMorgan's positioning suggests their risk management teams believe at least one of these scenarios has elevated probability. To make sense of JPMorgan's move, we need to understand where we are in the market cycle. Financial markets move in cycles. These cycles are driven by psychology, credit conditions, valuations, and external shocks. Understanding which phase of the cycle we're in and where we might be heading is essential for intelligent capital allocation. Currently, we're in an interesting phase. Equity markets have recovered from pandemic lows and have moved to historically elevated valuation levels in many sectors. Bond markets are pricing in expectations for lower interest rates over the next few years. Credit spreads have compressed, suggesting investors believe the economic outlook is benign. But beneath the surface, several concerning indicators are present. Government debt is expanding rapidly. Major economies are running large fiscal deficits, even as growth moderates. Central bank policy has shifted from aggressive tightening back toward accommodation. Corporate earnings growth has stalled in many sectors. Consumer balance sheets are showing signs of strain. This is the environment where institutional risk managers start rotating capital. They don't abandon equities or bonds entirely, because doing so means missing potential upside. But they reduce concentration, they increase diversification, and they add hedges. Precious metals are the classic hedge in this environment. Markets move in part based on fundamental economic reality, but also powerfully based on psychology and crowd behavior. When an asset has been neglected by the crowd, when most investors aren't paying attention, when valuations are depressed, when sentiment is negative, that's often when sophisticated institutions start accumulating quietly. Over the past decade, precious metals have been unfashionable. The returns have been muted. Real interest rates have been high. for portions of the period, reducing the opportunity cost of holding non-yielding precious metals. Investors have been intoxicated by technology stocks and crypto. Precious metals have felt outdated. This is precisely the environment where institutional investors start positioning. They understand that crowd psychology can shift dramatically. What's unloved can become beloved. What's been neglected can become essential. And when the crowd realizes they need precious metals, when fear enters the market, prices move quickly and dramatically. JPMorgan's positioning might be a bet on exactly this psychological shift. They may be accumulating while precious metals are still unpopular, positioning for the moment when the broader market recognizes their value. Markets often move through feedback loops. A small initial move prompts others to follow. That creates more momentum. More institutions follow. Eventually, you have a substantial move that seems to come out of nowhere to those who weren't paying attention. JPMorgan's positioning in silver might be the beginning of such a feedback loop. Think about what happens if, over the next 6 to 12 months, major institutions and central banks gradually increase their precious metals allocations. Word spreads. Financial media begins covering the story. More retail investors become interested. Demand accelerates. With silver's relatively small market size compared to equities or bonds, even modest increases in institutional demand can drive significant price appreciation. This attracts more capital. More institutions see the momentum and allocate. The feedback loop strengthens. Is this guaranteed to happen? No. But it's a plausible scenario that JPMorgan's risk managers may be positioning for. To understand why institutions are quietly moving toward precious metals, you need to grasp the fundamental debt situation. Global government debt stands at approximately 100% of global GDP. In developed nations, government debt often exceeds 100% of national GDP. In some cases, it approaches 150%. This debt was accumulated gradually over decades, but accelerated dramatically during the pandemic. Governments borrowed trillions to support their populations and economies. Central banks printed trillions to purchase government bonds. The question isn't whether this debt is sustainable in the abstract. Questions of sustainability depend entirely on growth rates, interest rates, and inflation dynamics. The question is, what happens if these dynamics shift? If real interest rates rise significantly, if inflation falls but interest rates remain elevated, government debt servicing becomes very expensive. Governments would face pressure to either cut spending or print money. Both options benefit precious metals. If inflation reaccelerates, if central banks are forced to print money despite inflation pressures because debt levels are unsustainable, precious metals provide a hedge. If growth slows while debt levels are high, if we enter a low growth, low inflation environment, the real value of debt becomes crushing, and alternative assets become attractive. JPMorgan's positioning in precious metals is partly a hedge against this debt-driven uncertainty. It's an acknowledgement that the current configuration of debt, rates, and growth is unstable. The inflation debate will define the next decade of financial markets. One camp believes inflation is transitory and will gradually move toward central bank targets. They believe that supply chains will normalize, that energy prices will stabilize, and that monetary policy will be accommodative enough to support growth without reigniting inflation. Another camp believes inflation pressures are more persistent. They point to tight labor markets, ongoing supply constraints, elevated debt levels that require monetary accommodation, and geopolitical tensions that disrupt commodity supplies. JPMorgan's increased precious metals position suggests their economists lean toward the second view, or at least they believe the probability of persistent inflation is elevated enough to warrant hedging. Silver, remember, has dual characteristics. If inflation accelerates, silver appreciates as a precious metal. If industrial demand recovers alongside inflation, silver appreciates as a commodity. Silver offers optionality in an inflation scenario. Another factor driving precious metals demand is global economic divergence. The United States, Europe, China, and emerging markets are experiencing different growth rates, inflation dynamics, and policy regimes. This divergence is creating currency volatility and capital flows. When global economic conditions are uncertain and divergent, investors seek assets that have value across all borders and currencies. Precious metals fit this description perfectly. JPMorgan operates globally. Their risk managers are acutely aware of the divergence. A position in silver provides a hedge against an uncertain global backdrop, where no single currency or economy is guaranteed to outperform. If you're currently holding a diversified portfolio, stocks, bonds, some cash, JPMorgan's positioning in precious metals has direct implications for you. First, it suggests that hedging is becoming more relevant. If a major institution like JPMorgan is taking a hedging position, it's a signal that they believe risk is asymmetrical. You might consider whether your portfolio has adequate hedges. Second, it suggests that traditional diversification, splitting your capital between stocks and bonds, may be insufficient. Stocks and bonds have both moved in the same direction during recent periods of stress. Precious metals have historically moved inversely. Adding a small precious metals allocation to your portfolio increases true diversification. Third, it's a signal to review your risk management. If JPMorgan is positioning defensively, it's worth asking, is my portfolio positioned to weather the scenarios that JPMorgan is hedging against? For investors who currently hold a traditional portfolio, perhaps 60% stocks, 40% bonds, JPMorgan's move might prompt reconsideration. You might consider a modest precious metals allocation, not a large one. Precious metals are volatile, they don't generate yield, and they shouldn't be a core holding. But $5 or 10% of a portfolio in precious metals, particularly silver, which offers industrial exposure alongside precious metal characteristics, can provide meaningful diversification benefit. This isn't speculation. It's prudent diversification based on the historical role of precious metals during periods of financial stress. How would you implement this? Several options exist. The most direct approach is to purchase physical precious metals, actual silver coins or bars. This provides genuine asset ownership with no counterparty risk. Another approach is to purchase precious metals through an ETF or mutual fund. This is more convenient and liquid, though it does introduce counterparty risk, the fund company the custodian. A third approach is to use mining stocks or precious metals producers. These offer leverage to precious metals prices, but introduce company-specific risk. For most investors, a combination of physical holdings and precious metals ETFs makes sense. Keep 70 to 80% of your precious metals allocation in simple, liquid forms, ETFs. Keep 20 to 30% in physical holdings as true insurance. Here's a critical point. You don't need to time the precious metals move perfectly. In fact, trying to time it perfectly is a mistake. The reason JPMorgan can move with confidence into precious metals is because they're building a position over time. They're not trying to catch the exact bottom. They're gradually accumulating as they see the fundamental case strengthening. You should adopt the same approach. If you've decided that a 5% precious metals allocation makes sense, you don't deploy all 5% at once. You deploy it gradually over 3 to 6 months. This averaging approach reduces timing risk and removes the psychological burden of trying to catch the exact low point. Dollar cost averaging into precious metals, investing a fixed amount each month regardless of price, is one of the most emotionally and logically sound approaches available to most investors. If you're currently underweighted or absent from precious metals, JPMorgan's positioning in silver is a case for entering the market. This doesn't mean rushing in and deploying significant capital immediately, but it does mean that now is a reasonable time to begin building a position. Why? Because you're still entering before crowd recognition. Most retail investors aren't talking about precious metals yet. Financial media isn't breathlessly promoting silver. Precious metals haven't yet experienced the price appreciation that would signal that the institutional positioning phase is complete. The best time to enter an asset class is when it's unpopular, when institutional capital is flowing into it quietly, and before the broader crowd has noticed. We're in that window right now. Before allocating capital to precious metals, do your research. Understand? What are the supply and demand fundamentals for silver? Is industrial demand likely to accelerate or decelerate? What are the major mines that produce silver and where are they located? What geopolitical risks might disrupt supply? Understand the historical relationship between precious metals and various macroeconomic conditions. When do precious metals thrive? When do they struggle? What scenarios would benefit precious metals? And how likely are those scenarios? Understand the mechanics of precious metals investing. What are the costs of purchasing and storing physical metals? What are the expense ratios of various ETFs and mutual funds? What are the risks of mining stocks? Do this research before you commit capital. An informed investor makes better decisions than an uninformed one. Here's something absolutely critical. Don't expect explosive returns from precious metals in the near term. Precious metals appreciate when specific conditions exist, when inflation accelerates, when financial stress emerges, when currencies weaken. They may appreciate gradually over years, or they may appreciate dramatically over months in response to a shock. But precious metals aren't growth investments. You shouldn't expect them to compound at 10% annually like equity markets historically have. You should expect precious metals to provide a hedge against your other holdings. When stocks and bonds decline, precious metals often hold value or appreciate. Provide optionality in extreme scenarios. If inflation truly accelerates or if financial stress emerges, precious metals can appreciate significantly. Provide diversification. Precious metals move to different drivers than stocks and bonds, reducing portfolio correlation. If you enter precious metals with realistic expectations, viewing them as insurance and diversification rather than wealth creators, you'll make better decisions and experience less frustration. What size allocation makes sense for a potential investor entering precious metals for the first time? The answer depends on your risk tolerance, your existing portfolio, and your views about future macroeconomic conditions. But as a general framework, Conservative investors might allocate 2 to 3% to precious metals. This provides genuine diversification and hedging without creating significant volatility. Moderate investors might allocate 5 and 7% to precious metals. This is substantial enough to provide real hedging benefit while remaining manageable from a volatility perspective. Aggressive investors who are highly confident in the macroeconomic case for precious metals might allocate 10 to 15%, but this is only appropriate if you have strong conviction and can tolerate the volatility. Most investors should be in the 5 to 7% range. This provides meaningful diversification while remaining proportional to precious metals' role in a portfolio. If you're entering precious metals as a new investor, don't try to time the market perfectly. Instead, establish your target allocation. And let's say you decide 5% is appropriate for your portfolio. Divide that allocation into 3 to 6 equal tranches. If your target is 5%, that might mean 1% monthly allocations over 5 months. Commit to deploying each tranche on schedule, regardless of price movements. This removes the psychological element and ensures you're averaging into your position. Monitor your allocation quarterly. As precious metals prices fluctuate, your allocation will drift. If precious metals surge to 8% of your portfolio, you might reduce back to 5%. If they fall to 2%, you might add. This systematic, disciplined approach is far superior to trying to catch exact market bottoms or making emotional decisions based on short-term price movements.
The biggest mistake most investors make with precious metals is allowing emotion to drive their decisions. When precious metals prices are rising, investors feel excited and FOMO, fear of missing out, drives them to invest. They deploy too much capital at the wrong time, buying after the move has already occurred. When precious metals prices are falling, investors feel panicked and regret. They sell at the bottom, converting temporary losses into permanent ones. To avoid this, commit to your allocation in advance. Write down your target allocation. Write down your plan for getting there. Then follow the plan mechanically, regardless of your emotional state. Your emotions are not a reliable guide to market timing. Discipline is. Another mistake is becoming over-concentrated in precious metals as a response to macroeconomic concerns. You might read about government debt and inflation fears and decide to shift 30% of your portfolio to precious metals. This is a mistake. Precious metals should be a hedge, not a core holding. If your core portfolio, stocks and bonds, declines 20%, and your precious metals hedge appreciates 5%, your overall portfolio decline is dampened. This is the goal. But if you've over-concentrated in precious metals, you've created an even larger problem. You've reduced your exposure to assets that generate returns over time. Even in an inflationary environment, stocks can provide inflation protection through dividend growth and earnings appreciation. Maintain balance. Precious metals should be 5 to 10% of your portfolio, not 30%. A critical mistake is using leverage or complex derivatives to amplify your precious metals exposure. Some investors use margin to purchase more precious metals than they can actually afford. Others use options or futures to lever their positions. This is dangerous. Precious metals are volatile. If you're leveraged and the price moves against you, you can be forced to liquidate at the worst possible time. Leverage can turn a modest loss into a catastrophic one. If you believe in precious metals as a hedge, there's no need for leverage. You're not trying to get rich from precious metals. You're trying to hedge your other holdings. Simple, unmargined purchases of physical metals or ETFs accomplish this goal perfectly. Avoid leverage, avoid derivatives, avoid complexity. Simple is better. Another behavioral mistake is chasing every news story or social media trend related to precious metals. You'll read headlines suggesting that silver will reach $200 per ounce, or that an economic collapse is imminent, or that governments are about to confiscate gold. Don't let this drive your decisions. Most financial news is noise designed to create engagement and emotion. If precious metals are truly set to appreciate significantly, your systematic, disciplined approach will capture that appreciation. You don't need to chase hype. Instead, establish your allocation, build your position systematically, and then ignore the noise. Check your portfolio quarterly. Rebalance if necessary. Otherwise, let your investment work. On the opposite end, don't fall into the trap of endless research and analysis paralysis. You could spend months researching silver supply dynamics, reading economic forecasts, and analysing historical correlations, but you'd never actually deploy any capital. At some point, you need to make a decision and act. The goal isn't perfect analysis. The goal is sound decision-making with adequate information. Research long enough to have conviction that precious metals belong in your portfolio. Then, act. Build your position systematically. Then, stop second-guessing yourself. A final behavioral mistake is ignoring the costs involved in precious metals investing. Physical metals have storage costs, insurance costs, and bid-ask spreads when you buy or sell. ETFs have expense ratios and trading costs. Mining stocks have bid-ask spreads and brokerage commissions. These costs seem small in isolation, but compound over time. A 1% annual fee on a precious metals allocation might seem reasonable, but over decades it adds up. Compare options carefully. Understand the costs. Choose the lowest cost option that meets your needs. This might be a simple silver ETF with a 0.20% expense ratio, rather than a more exotic precious metals fund with a 1.5% expense ratio. Small differences in costs create large differences in outcomes over time. When JPMorgan takes a concentrated position in precious metals, it's expressing a view about risk. Specifically, JPMorgan's risk management teams have assessed that the probability of significant inflation, currency weakness, or financial stress has risen enough to warrant hedging. The cost of that hedge, in terms of foregone returns from precious metals' lack of yield, is worth paying. The diversification benefit of precious metals, their inverse correlation to stocks and bonds, is valuable in the current environment. This is not a prediction of economic collapse. JPMorgan still owns substantial stocks and bonds. They're still lending to businesses and governments. They still expect economic activity to continue, but they're hedging. And that hedging stance is important information for you as an investor. When major institutions begin shifting toward defensive positioning, it typically precedes a period of market weakness or heightened volatility. This doesn't mean a crash is coming tomorrow. It means that sophisticated investors have begun raising their risk awareness and adjusting their portfolios accordingly. This is precisely the moment when individuals should do the same. Not panic, not sell everything, but rebalance, hedge, reduce concentration, increase diversification. JPMorgan's move is a signal that the institutional consensus, which matters enormously for market direction, is shifting from complacency toward caution. Before making any changes, honestly assess your current portfolio situation. How much of your portfolio is currently in precious metals? If the answer is 0 or close to 0, you're underallocated relative to prudent diversification. How leveraged is your portfolio? If you're on margin or using derivatives significantly, you have excessive risk. How concentrated is your portfolio? If more than 20% is in a single stock or sector, you have concentration risk. How many assets do you actually own? Research shows that diversification benefits appear around 15 to 20 holdings. Fewer than that suggest you're taking unnecessary idiosyncratic risk. Answer these questions honestly. You don't need to share your answers with anyone, but you need to be truthful with yourself. Based on your assessment, create a written allocation plan. Write down your target allocation to major asset classes. For example, stocks, 50%, bonds, 35%, precious metals, 10%, cash, 5%. Your numbers may differ based on your age, risk tolerance, and time horizon. But write them down. Then, write down exactly how you'll achieve this allocation. For stocks, which funds or individual stocks will you buy? For bonds, which funds or individual bond positions will you buy? For precious metals, which combination of physical metals, ETFs, and mining stocks will you use? For cash, which instruments will you use for liquidity? Be specific. Write this down. This is your roadmap. Now, create your implementation timeline. When will you deploy capital? How much each month? How long will the process take? For example, I will allocate $500 per month to precious metals over the next 12 months, reaching my 10% target allocation. This is specific, measurable, and removes emotion from the process. Finally, establish a review schedule. I recommend quarterly reviews, once every 3 months. During your quarterly review, check your allocation. How much is each asset class? Rebalance if necessary. If an asset class has drifted more than 2 to 3% from your target, rebalance back. Review any fundamental changes. Have your goals changed? Has your risk tolerance shifted? Do you need to adjust your allocation? Document your review. Write down what you observed, what you decided, and why. This creates accountability and helps you learn over time. This disciplined approach removes emotion, creates systematic decision-making, and significantly improves long-term outcomes. One thing that's different about our current era is information availability. In the 1970s, when inflation surged and precious metals became valuable, individual investors didn't have access to the information and analysis that institutional investors had. Precious metals surged from obscurity, and retail investors only caught on after substantial moves had already occurred. Today, information flows instantly. If you're watching this video, you're already aware of JPMorgan's positioning and precious metals' potential role in a portfolio. This awareness is valuable. It allows you to build your position early, before the broader market has woken up to the opportunity. But it also requires discipline, because once the market has woken up, information alone won't make you money. You'll make money only if you've already built your position, and you'll only build your position if you act now, while precious metals are still unpopular. One of the biggest mistakes investors make is waiting for perfect confirmation before acting. You might think, I'll wait until precious metals have already started rising, then I'll know for sure I should buy. But by then, the move has already begun. You'll be buying after a 10% or 20% appreciation, not before. Your returns will be diminished. The key insight is that you don't need perfect confirmation. You need reasonable conviction. And the evidence is reasonable right now. JPMorgan is positioning defensively. Macroeconomic conditions are uncertain. Precious metals provide diversification. You're underweighting precious metals in your portfolio. These are sufficient reasons to begin building a position now.
The emotional challenge of this approach is that you'll feel uncertain. You'll think, what if precious metals fall further? What if my allocation never appreciates? These thoughts are normal. Every investor experiences them. The difference between successful and unsuccessful investors is that successful investors acknowledge these thoughts and then take action anyway. The reason JPMorgan has built their wealth is not because they always know what's going to happen. It's because they've learned to act despite uncertainty, using systematic approaches and risk management to ensure that they're positioned for a range of possibilities. You can do the same. Before we conclude, let's be very clear about what precious metals are not. Precious metals are not a replacement for stocks. Stocks have historically been the best long-term wealth creators. Precious metals lack this return generation capability. Precious metals are not a path to quick riches. If you're looking for assets that will generate 50% returns in a year, precious metals are not the answer. Precious metals are not a speculation opportunity for active trading. The bid-ask spreads and transaction costs make short-term trading expensive. Precious metals are for holding, not trading. Precious metals are not uncorrelated to everything. During periods of strong growth and rising real interest rates, precious metals can struggle. They're not a panacea. What precious metals are, a diversifier. They move to different drivers than stocks and bonds, a hedge. They appreciate during the scenarios where stocks and bonds struggle, a store of value. They maintain purchasing power over long periods, insurance. Like all insurance, you hope you don't need it, but you're glad you have it if you do. Precious metals deserve a place in a properly diversified portfolio, but they deserve a supporting role, not a starring one. Let me end with an empowering message. The financial system is complex. There are forces far larger than any individual. Central banks, governments, corporations, and trillions in capital flows. It's easy to feel powerless in the face of this complexity, but you're not powerless. You have agency. You can educate yourself about financial fundamentals, understand macroeconomic cycles and their implications, build a diversified portfolio positioned for multiple scenarios, adjust your allocation as conditions change, think long-term instead of reacting to short-term noise, maintain emotional discipline when others are panicked or euphoric. These skills create outcomes. Over decades, disciplined investors with sound portfolios achieve financial security. Undisciplined investors struggle, regardless of market conditions. JPMorgan's positioning in precious metals isn't telling you what to do. It's simply information. Information that sophisticated investors are raising their defensive positioning, that they believe risks are elevated, that diversification is becoming more valuable. You can choose to ignore this information, you can continue with your current allocation, or you can choose to act, to build a more diversified portfolio, to position yourself for a range of scenarios, to take agency over your financial future. The choice is yours. But choose consciously. Don't default to inaction simply because inaction is easy. Here's a final framework for thinking about all of this. Assess your current portfolio, your asset allocation, and your level of diversification. What is your target allocation? What does a well-diversified portfolio look like for your situation? Be specific. Write it down. Include timelines and amounts. Ignore emotions. Ignore noise. Follow your plan. Rebalance when necessary. Change your allocation if your circumstances have changed fundamentally. This isn't about next month or next year. It's about the next decade and beyond. This framework works, not perfectly, but better than the alternative, which is reactive decision-making driven by emotion and fear. JPMorgan's quiet positioning in precious metals is a signal, not a prediction, not a guarantee, but a signal from one of the world's most sophisticated financial institutions that they believe diversification into precious metals is prudent. You now have that same information. What you do with it is your choice. But I encourage you to view this not as a reason to panic or to speculate. I encourage you to view this as a reason to reflect on your portfolio, to assess whether your current allocation is positioned for the scenarios that JPMorgan and increasingly other institutions believe have elevated probability. If precious metals play no role in your portfolio, that's worth examining. If they play a modest role, 5 to 10%, that's likely wise diversification. The beautiful thing about JPMorgan's positioning is that it validates something we've known for millennia. In uncertain times, diversification is prudent, and precious metals, particularly silver with its dual characteristics, are a time-tested diversifier. The opportunity is available to you now, before the crowd has noticed, before sentiment has shifted, before prices have appreciated significantly. That window won't stay open forever. Institutions will continue accumulating. Eventually, the broader market will notice. Prices will appreciate, and the opportunity to enter at today's prices will have passed. You don't need to rush, but you do need to act. Within the next few months, you should have a precious metals position established. Not a large one, a meaningful one. 5 to 10% of your portfolio. Disciplined, systematic, long-term focused. That's my guidance. Thank you for watching. Thank you for taking your financial future seriously. And thank you for being the kind of investor who thinks carefully about these issues, rather than simply reacting to headlines. Subscribe to this channel if you found this analysis valuable. We'll continue providing the kind of thoughtful, disciplined financial guidance that helps you make better decisions over time. Until next time, remain disciplined, remain diversified, and remain focused on the long term.